Wednesday, July 26, 2017, Monaco 64, home of alternative economics and contrarian views. So I like to talk about central banks and why they can't have their cake and eat it. First of all, I'll go over this idiomatic expression or proverb, whatever you're going to call it. According to Wikipedia, the proverb literally means you cannot simultaneously retain your cake and eat it. And in the case of the central bankers, what I think it means is the following. Or that one cannot or should not try to have two incompatible things. And why do I say that? Well, let's have a look here. There's an article on Zero Hedge, came out early today, overnight. It says Bank of England warns of spiral of complacency over soaring consumer debt. And this article talks about the car loan debt, that's growing in the US, but also in the UK. There was an article a few weeks ago in Zero Hedge where they covered another article by the Daily Mail here in the UK where young reporters went to 22 different car dealerships in the UK and they were offered very easy terms to buy new cars, even if they didn't have any money down, even if they had bad credit, or even if they were unemployed. So that's the preface to the story. And then they mention a member of the Bank of England who spoke in Liverpool recently. His name is Alex Brazier of the Bank of England, and it's an article from The Guardian, and he says, 10 years ago, an unsafe financial system caused financial crisis and economic disaster. And then he goes on to say that, borrowing is getting out of control and that the Bank of England might have to do something about it if it continues like that, especially consumer credit. The only thing that he never mentions, I've read through the article, I'll put the link, below in the description. He never mentions the fact that the Bank of England has kept rates, below 1% for the last 9-10 years. Right now it's 0.25%, so basically at 0%. He never mentions that. Never mentions that the Bank of England is, creating money out of thin air, which is loans to buy government bonds, to keep the government borrowing irresponsibly as it is. We've doubled the national debt, since 2010 when the Labour Party lost power. It's gone from around 800 billion to 1.7 trillion right now, the national debt of the UK. So here's the Bank of England saying, oh, consumer debt is getting too frothy, we might have to do something about it. Instead of looking at themselves in the mirror and saying, we're causing this. We want the government to be able to borrow for nothing and spend money irresponsibly and leave that debt for the taxpayer. But when the taxpayer or consumer starts borrowing, no, that's got to stop. And I'm not saying that you should go out there and borrow under these, very irresponsible terms. All I'm saying is that they've got kind of two standards. The government and the bankers, they can borrow billions or trillions, for nothing. But when consumers start borrowing for nothing, then, they raise a red flag. It's quite amazing. Personally, central bankers I think central bankers are the problem. They're the ones that create the artificial markets. If they left everything to the market, if they left the price of money, which is interest rates, to the market, if they didn't interfere in the market, we wouldn't have these crazy situations or crazy conditions we have now. I'm not saying in a free market you don't get bubbles, but they don't, you know, so they don't go crazy as they go under a system where the government and the central banks are involved trying to, you know, feather their nest, so to speak. So with that, I want to talk about a couple of books, and I recommend them. Some of you probably have seen these books. I've made videos about them, but for new subscribers, it's always good to refresh on it. The first one is by Murray Rothbard, who was a famous Austrian School of Economics economist, and it's called What Has Government Done to Our Money? And it's not a long book. It's very easy to read. It's less than 200 pages, but and it starts from, you know, the beginning, from the history of money. I'm not going to go through the whole book, but it's really interesting to understand what money really is. The first part, it says money in a free society, and then he talks about the value of exchange, barter, indirect exchange, benefits of money, and I'll just give a brief summary. Yeah, the value of exchange. So basically, he starts out in a primitive society where people are doing different things, and you know, they want to, let's say someone fishes, but they want to have some milk. They're sick and tired of eating fish the whole time and drinking water. And then there's a farmer who has some cows. He has a lot of milk. He's tired of, you know, drinking milk and eating whatever he can grow. And he wants something different, something like fish. So they exchange, you know, they're able to exchange those goods that are, you know, they desire, both desire. A lot of times, though, there is, you know, the fisherman or the farmer can't find someone else who has what he wants or she wants. So it's very difficult to exchange, to barter. So what happens is that through, you know, trial and error, people in the market, you know, farmers, traders, or whatever, miners, they find a commodity or a good that almost, yeah, well, everyone wants, and that everyone will accept as a form of barter. And that becomes indirect exchange, and that commodity becomes money. And historically, it's been many things, from clay tablets in, you know, in Sumeria, well, the old civilization between the Tigris and Euphrates. It can be cows, it can be salt, it can be silver, gold for thousands of years. That is money, is the commodity that everyone will accept because they desire it. And the other quality of money is that you don't consume it. You desire it, but it remains fairly abundant, because if you consume the money, then, you know, there isn't any money left. And over the years, he explains, that has been gold and silver. But in this book, you know, he just points out how governments over the centuries have hijacked this system of free market and exchange, indirect exchange. And it's been indirect exchange that has allowed society and members of society to specialize. Because if you had to produce everything, you wouldn't be a specialist in anything. You'd be a subsistent farmer, or, you know, you would have, but indirect exchange and money allows people to specialize. And that's how we've had progress. And that's why it's important that, you know, governments and central banks disappear. Governments butt out of, you know, controlling the money of a free market. And that's what central banks do. And that's why it's related to this article I spoke about. They just screw everything up. And then the other book I'm going to talk about is one by a former central banker, Mervyn King. He was the head of the Bank of England, a governor during the '08 crisis. And his book is called The End of Alchemy, Money, Banking, and the Future of the Global Economy. Well, it is coming from a mainstream person, you know, part of the elite. But he does say some things that make sense. And on page 261, he talks about more radical reforms. And he basically says that he thinks the best thing would be to go back to a plan called the Chicago Plan from the 1930s. I think it was proposed by Irving Fisher, which was who was a famous American economist, and basically making banking, separating commercial banking, where money is like a utility, and then having other banks or investment banks which are separate from that system. You know, in this plan, the money, commercial banking, there's 100% reserves. So there's no fractional reserves. And then you might ask, so how can, you know, people borrow money for projects or investments? Well, the proposal is that then you have a separate, banking system where you can actually issue equity. So if investors or this special bank want to lend money to someone who wants to start a new business, they will issue equity to this person or institution. And that's how you separate it. You know, that's interesting, but he's not head of the Bank of England anymore. And he says the reason why it's not done, why these reforms aren't done, and, you know, we keep getting the same problems, and we haven't seen big reforms since '08. We still have the huge OTC derivatives. We still have the banks that were too big to fail back in '08 are even bigger now. And he says in this book, the reason this doesn't happen, the reforms, and we don't go back, mind you, he doesn't say we need to get rid of central banks, but still, it's a step. He says the reason is that all the big banks that have become even bigger, they've got all the money, all the clout, they're lending to the governments at almost zero. They've got lobbying power. They don't allow this to happen. So until we see that, the system's going to remain crazy, and that's why I advise for people to be outside the banking system if you can. Of course, we have to have some exposure to banking to pay our bills and to have some money to, you know, but I would keep it to a minimum and be your own central banker, as Jim Sinclair, Greg Manarino, and I, and even Jim Rickard says, be your own central banker. You know, insure yourself outside the banking system by having physical gold and physical silver, or by owning farmland unencumbered by that, or owning fine wines as well. Cryptocurrencies, the only problem with that is that it's digital. And if you do sell your cryptocurrencies, you put it back into fiat money. What I recommend, if you take profit in cryptocurrency, the way to do it first is to put it into dollars or your national currency, but then I recommend getting out of it and putting it into physical gold and silver. So yeah, that's what I wanted to talk about today. Mr. Brazier from the Bank of England, you can't have your cake and eat it. So if you enjoyed this video, please like, share, subscribe if you haven't yet, and watch me on steemit.com as well. I'll talk to you later. Bye.